Before recessions appear in headlines, before CEOs panic, before layoffs begin, there is one market that often sees the danger first: the bond market. And its warning system is called the yield curve. Now, at first glance, this may sound like one of those boring finance terms hidden inside economics textbooks. But in reality, the yield curve has predicted some of the biggest economic disasters in modern history: the dot-com crash, the 2008 financial crisis, even the 2020 recession. And what makes this fascinating is that the yield curve doesn't scream. It whispers, quietly, mathematically, relentlessly. Today we'll understand why the entire financial world becomes nervous when this curve starts behaving strangely. To understand the yield curve, we first need to understand government bonds. Governments constantly borrow money, and they do that by issuing bonds. Now, these bonds come in different time periods. Some mature in 3 months, some in 2 years, some in 10 years, and some even in 30 years. When you lend money to the government pays you interest. That interest is called the yield. Now imagine placing all these yields side by side based on time. That visual relationship between short-term yields and long-term yields is the yield curve. So the yield curve is not one single bond. It's the relationship between borrowing costs across different time horizons. Normally, the yield curve slopes upward, meaning long-term bonds usually offer higher yields than short-term bonds. But why? Because time creates uncertainty. If I lend money for 30 years instead of 3 months, I'm taking much bigger risks. Inflation could rise. The economy could change. Interest rates could move. My purchasing power could erode. So investors demand extra compensation for locking their money away longer. That's why long-term yields are generally higher. And this upward slope sends an important message. Investors trust the future. It says the economy is expected to grow normally. Inflation is manageable. And the financial system looks healthy. An upward sloping yield curve is basically the economy saying the following: the future still looks worth investing in. The yield curve is not just a bond market chart. It's a psychological map of the economy. Because every yield on this curve represents expectations. Expectations about growth, inflation, interest rates, fear, confidence. And here's what makes it powerful. The bond market is dominated by extremely sophisticated institutions: pension funds, central banks, insurance giants, massive asset managers. These are not emotional retail investors chasing hype. These are people managing trillions of dollars. So when the yield curve changes shape, the market is collectively telling you something about the future. It's not predicting with certainty, but it's revealing what the smartest money in the world is beginning to fear. Now we arrive at the moment markets fear the most: yield curve inversion. This is when short-term yields suddenly become higher than long-term yields, which is completely unnatural. Think about it. Why would investors accept lower returns for lending money over 10 years than over 3 months? That only happens when investors become deeply pessimistic about the future. Usually, this begins when central banks aggressively raise short-term interest rates to fight inflation. At the same time, investors begin worrying that those high rates will eventually slow the economy down. So they rush into long-term bonds for safety. That demand pushes long-term yields downward. Eventually, the curve flips upside down. And historically, that inversion has often been followed by recession. An inverted yield curve is not random chaos. It is collective fear becoming visible. The market starts believing growth is weakening, that inflation will cool, that future interest rate cuts are coming. And because investors expect economic weakness ahead, they begin buying long-term government bonds aggressively. Why? Because in uncertain times, safety becomes more important than high returns. This buying pressure pushes long-term yields lower. So inversion is really the market saying the following: the future economy looks weaker than the present economy. And this is why the bond market is so respected. Because often, it starts pricing in fear before the economy officially breaks. Now here's where things become dangerous. The yield curve doesn't just predict problems. It can actually help create them. And banks sit right at the center of this mechanism. Normally, banks borrow money short-term and lend money long-term. For example, they may pay depositors 3% and lend mortgages at 7%. That spread becomes their profit. But during inversion, short-term rates rise too much. Suddenly, banks may be borrowing at 6% while lending at 5%. The business model breaks. Lending becomes unattractive. So banks reduce lending activity. Businesses struggle to borrow. Consumers struggle to spend. Economic activity slows further. This is why inversion becomes economically dangerous. It quietly tightens the entire credit system. This is why investors take the yield curve so seriously, because historically, its track record is terrifyingly good. In the late 1990s, the curve inverted before the dot-com crash. In 2006 and 2007, it inverted before the 2008 financial crisis. And again in 2019, inversion appeared before the 2020 recession. Now this does not mean inversion causes recessions directly every single time, but it repeatedly signals that something beneath the surface is weakening. And the frightening part is the following. The bond market usually notices the stress before headlines do. Once inversion happens, fear starts spreading across the financial system, because inversion signals four dangerous things simultaneously: slowing demand, tightening liquidity, weakening confidence, and rising recession risk. And psychology matters enormously in economics. When businesses become fearful, they slow hiring. When consumers become fearful, they reduce spending. When investors become fearful, they rotate into safer assets. This collective caution starts slowing the economy in real time. So the yield curve doesn't just reflect fear, it amplifies it. Now, after 2008, things became more complicated, because central banks started interfering in bond markets on an unprecedented scale. Through quantitative easing, central banks purchased trillions of dollars worth of bonds. This artificially pushed long-term yields downward. At the same time, massive liquidity injections flooded markets with cash. So today, many economists debate whether the yield curve still works exactly the same way as before. Maybe the signal has become noisier. Maybe central bank intervention distorts the warning. But even today, the underlying logic remains powerful. When investors lose confidence in future growth, the curve still reacts. At its core, the yield curve is not really about bonds. It's about trust. A normal curve says, the future looks stable. An inverted curve says the following: something beneath the surface is breaking. And this is why bond markets matter so much. Because bond investors are forced to think long-term. They cannot survive on hype. They cannot survive on narratives. They survive by understanding risk. So when trillions of dollars collectively move towards safety, the yield curve captures that shift instantly. It becomes a snapshot of economic confidence itself. The stock market is loud. It reacts to headlines, momentum, excitement, narratives. But the bond market is different. It is quieter, larger, more analytical. The stock market often reflects emotion. The bond market often reflects reality. And the yield curve is the bond market's voice. That is why economists, investors, and central banks watch it obsessively. Because long before the world admits something is wrong, the bond market usually already knows.